All right, well, joining me now to break down the market response to all of this data and the data, because there is a lot of it as we work our way through it post-government shutdown. I do want to bring in Jay Woods. He's Chief Market Strategist at Freedom Capital Markets. Jay, always good to see you, especially on a busy day.
Yeah, very busy, and happy belated birthday to you as well.
Oh, thank you very much, sir.
You
Always a
got
friend of the show here at NYSE Live. And let's talk this data because we do see futures bouncing around, but as of late, fractionally lower on this news. What can you share?
Yeah, well, 4.6% was the unemployment number. We were looking for 4.5%. That's got our antenna up a little bit and really puts a focus on the CPI number that comes out on Thursday. When you break down those jobs numbers, the impact was felt by the government shutdown. It was government jobs that were hit the hardest. The private sector seemed to be okay. So we're kind of in a little bit of a quandary right now to see exactly, is this going to continue? Right now, the pattern we continue to see in the job market is we're not really laying off a lot of people, but the hiring isn't robust either. So it's kind of this freeze, and this tends to happen seasonally around this time of year. So while it isn't good that we saw this number increase, when you look at the odds for a rate cut, you go to the CMEgroup.com, you can see that in real time. There was no real change. It was actually roughly about 25% chance of a cut still in January. So I think this is one that has our antenna up, but we're going to focus on inflationary data because when we talk about dual mandate, all right, we cut because of jobs, and now we're going to still have some work to do there. But if inflation is non-transitory, we hope it's transitory because of the tariff increases, and we see that increase to 3.1 or higher, then we are going to have a lot of Fed speak to go through before that January meeting. But right now, this is something that's not causing a ripple effect, but it has us really focused on that CPI number.
Yeah. Now, immediately when the numbers were released at 8:30, we had seen futures actually rise a bit, setting for a higher open. Now they have retreated just a little bit, as I think investors probably digest what is a large swath of this delayed data. But in it did show an October estimate that showed 105,000 jobs actually estimated were lost in the month of October. Shed some more light on those figures.
Yeah, that goes more back. Goes back to the government shutdown. That is where we're seeing most of those job losses. Were those furloughed and they're going to come back into the workforce? We don't know, but the shutdown was going to have an impact. We knew that. So we focus now on the overall trend, and unfortunately that trend is ticking higher, and that's where the concern is. So seeing that this data was delayed, seeing there was a reason for that number to increase, it's not going to really cause that much angst here. But as you mentioned, a little volatility around the flat line. We're still, 1% from all-time highs, which were just set last week. And I think what we're going to focus on is some of that rotational theme continuing at the end of this year when we're getting away from some of those tech leaders and going into some of those other sectors that have been underperforming and doing well lately.
Let's talk more about the semiconductor space because those stocks had ripped right in the wake of Liberation Day, but we have seen a rotation, as you referenced earlier, out of some of these high-flying tech names into a more broadened out rally, if you will. For semis, though, I think Micron is on your radar.
Oh,
what can you share?
Yeah, Micron earnings Wednesday after the bell. This stock has crushed it. It's up 182% year to date. The AI demand and the data center build is really where they've thrived. So they've been crushing it there. But here's the story. 4 of the last 5 times they've reported earnings, it's traded lower. Technically, as a technician, I see some topping patterns, some overbought conditions. It's about 70% above its 200-day moving average, a little overextended. And then you look at the other stocks in that space that have done well. Fundamentally, Broadcom, great quarter, good guide. It's sold off. NVIDIA, great quarter, good guide. It struggled to go much higher. It's still in that 175, 185 zone. So I think Micron may fall a victim to some of the other stocks that have done well, but price action didn't follow. And that is the theme we continue to see. Oracle, that's got a lot of people on edge. What is the debt issuance there? New leadership at Oracle was unsuspecting. So we have a lot of questions, and people want to take some profits and go into some sectors like transports, which are breaking out, Mag 7 names like a Tesla breaking out, that it may have more potential to grow going into the new year. So I see this more as portfolio adjustment and some taking some off the table, and that's what I would advise people to do as well. You have an 180% gain going into the end of the year. Yes, you're going to pay some taxes on it. These are good problems, by the way. But you may want to look for other opportunities, and I think that's what investors are doing.
Any other earnings that you're watching for?
Well, General Mills. All right. This is a boring one. Great company, trades right down here on the floor of the New York Stock Exchange, down 27% year to date. The staples have not been where people have been going. I think the staple sector is up 2% year to date. That's a good thing in a bull market. You don't want the staples. You don't want these defensive plays to lead us. But General Mills has been a stock. It's been a slow, steady downtrend. It's trading around $46. If you go back 10 years, $40 major support. I don't think we're going to see any kind of sell-off to give us a buying opportunity there. But what I'm looking for is a solid quarter, a fair guide, a guide in line, and then stability. A bottoming process takes time. I don't think it's going to have a V-bottom and come right back. But if we can get this stock to kind of pause like we want to see in Procter & Gamble and Clorox and a lot of these staples that have been beaten down, maybe that's a sign of a sector that's really going to start to do well as we kick off 2026. Great dividend. If you're looking for a boring name, and you're not looking for that explosive volatility, then I think General Mills may give us an opportunity come this earnings time.
Okay, let's talk 2026 because it's that time of year where strategists start submitting their forecasts, talking about expectations here in the new year.
Writing mine now, literally
okay,
writing it now.
So give us a tease as to what we can expect from yours, Jay.
No, I think, when you have a bull run like we've had, 3 consecutive years of double-digit growth, sometimes you can have that little bit of congestion, that pause, and that rotation. The rotation's coming out of technology, semiconductors, as we talked about, and as a result, those are the biggest market cap weighted stocks in the world. The other stocks that are going to lead us, if these pause, are going to be stocks that have great breadth for this market, but not really give us those double-digit gains. So I'm looking for moderate gains anywhere where we close around 7,100 to 7,250 in the S&P 500, of roughly 3 to 5% from where we are right now, and a lot of volatility coming into the year. We still have that Supreme Court ruling on tariffs. We have a mid-year election, which we'll talk about down the road.
Yep.
But in mid-election years, the market tends to stall. So I suspect we'll have some volatility. Little correction, some angst. I love that word. And by the end of 2026, we'll finish a little higher, but it won't be that stampede of a bull run that we've seen over the last 3 years.
All right, Jay Woods.
Yep.
Happy holidays, Jay.
Happy
Thanks
holidays
as always
to
for
you.
joining.
You
He's
got it.
Chief Market Strategist at Freedom Capital Markets.